welcome everybody to today's Coffee Talk. I'm John Paquette. I'm SVP Solutions for TIS's US market and your Coffee Talk host. And today's session is all about cash forecasting, which seems to be the topic that has consistently drawn the most interest from the Treasury community during the course of 2023. And for good reason. There are a lot of considerations in forecasting today that are causing this increased emphasis as the ever-evolving macro and economic landscape and how these variables impact how companies forecast their cash and liquidity. There are new and emerging technologies in forecasting, and companies are looking to how they can incorporate this into their processes to improve them. And as there are overall changing expectations around how Treasury produces the forecast, including the frequency and how that's used from a business standpoint to actually manage cash and liquidity on a day-over-day, week-over-week basis. And approaches to solving these challenges will obviously differ from organization to organization, but a commonality amongst all is that it takes data, technology, and experience, which is really the theme of today's Coffee Talk session. So today we're planning to have a conversation around forecasting its frame from that standpoint. And I'm very happy to have my co-speakers here with me today, Duncan Cole, who's the EMEA head of the Treasury Advisory Group for Citibank, as well as Gerard Tunenberg, who's the Treasury Director of Unilever. Gentlemen, welcome to the Coffee Talk, and maybe we can take a moment here to have you guys introduce yourselves as well, starting with Gerard.
Thanks, John. It's a pleasure to be here together with Duncan. My name is Gerard. I'm Dutch, but based in Switzerland, where I work for the Global Treasury Organization of Unilever. We've got a small team of 25 people looking after front office operations, systems, processes, corporate finance, and also external banking relations and external funding. My role is in the transactional banking systems team, and obviously this project, cash forecasting, was a big one on.
Great, thanks, Gerard. Duncan, over to you.
Sure, thanks, John, and look, delighted also to be here with you today. So good morning, afternoon, everyone, and Garrett, delighted to talk to you again on this topic. I suppose, yeah, my name is Duncan Cole with Citibank, based in Ireland, but have a global role actually, and I suppose in addition to supporting our client advisory practice within Citibank Treasury and Trade Solutions, TTS, and also more recently with all the emerging technologies and indeed the emerging fintechs that are part of our package within Citibank. I look after our strategic partnerships for our liquidity business within the TTS organization. So I'm delighted to be part of this conversation today.
All right, thanks a lot, Duncan. Yeah, maybe we could start here with just a very general question to kind of introduce the topic here a bit. I mentioned that there's an increased focus on cash forecasting. Gave a couple points in terms of what might be driving that. You know, some of the historical, geopolitical, macroeconomic events. The pandemic's a big one. Obviously, it stands out in people's mind. That kind of changed the game for how cash was moving within the business. Highlighted the importance of having a really airtight forecasting process. Obviously, there's some stuff looking into 2023 in terms of looming economic downturn and things like that. Rising borrowing costs, rising interest rates that companies are keeping a really close eye on. But Duncan, from the bank standpoint, maybe you can give us some insight into what's really driving the increased focus on cash forecasting.
Yeah, look, John. I mean, all of those things you mentioned are relevant, and really, I suppose, standing back from it, the frequency of what we used to call black swan events now is becoming increasingly common. So I think we have to come up with a different term for that, because I don't think we have black swan events anymore. We have frequent disruptions and drivers of needing a better view over liquidity risk and our currency risk. I suppose, look, in short, the short answer would be to our clients that that we're talking to. They're looking for more accurate forecasting. They're looking to forecast further out, and they're looking to forecast at a more, I suppose, at an increased frequency, and automation of all those processes to lead to that outcome is certainly driving a huge focus for our clients. And you're right, John. I mean, some of the disruptions, going right back maybe to the financial crisis of 2008, which is now, believe it or not, 15 years ago. It doesn't seem that long ago, but it's 15 years ago now. And that was viewed as the most serious financial crisis since, I think, 29, the Great Depression. But since then, so there's a big gap between 1929 and 2008. But since then, we've had lots of things going on. And you mentioned the pandemic of 2019, and that triggering almost a Marshall-like response to understanding the cash position and understanding the cash within a corporate trapped or indeed in use through supporting the supply chain. And there was really a paranoia to try and release some of that cash during the pandemic and post-pandemic. And we had many phone calls from our clients. How can we accelerate our understanding of our cash visibility? How can we accelerate understanding of our future cash visibility and our future exposures, our liabilities? And so really, it's it's accelerated, I think, the focus on technology and the focus on better understanding of data to really, as well, increase the frequency of forecasting, look further out, and indeed to improve the accuracy of forecasting. Many clients prior to that didn't measure accuracy, for example. So they may be forecasting, and it didn't really matter in some respects. And some of the more, I suppose, recent pieces now, where I suppose the interest rate environment is recovering to perhaps some would think normal levels. I mean, operating in a zero interest rate environment is actually not normal, many would think. So it's kind of recovering to what it used to be. And what that means is decisions, incorrect decisions, inefficient decisions are costly. So now it means something. If you get an investment decision or funding decision wrong in a higher interest rate environment, it actually has consequences, material consequences. I think some of that is driving, the need for greater visibility over cash and indeed future cash position. And just to say, I mean, the cost of capital is at its highest level. I mean, Garrett will tell you it's at its highest level now, I think, for about 40 years, and that combined with the multiple uncertainties, inflation, FX volatility, counterparty risks, shifting business models, right, with the emerging technologies as well. So the move from B2B to e-commerce, B2C, etc., and the evolving supply chains to support that means that greater visibility is required across all moving parts of the corporate world, and I think that's at the heart of it. And really, just to the forecasting, the better forecasting is sometimes can be seen as the outcome. Indeed, the outcome of that then is better decision making. But I think we'll explore in the next few minutes that really at the heart of that, there's some fundamentals that need to get right.
Maybe to add to Duncan and John, what we see as well within Unilever is that there's much more attention from senior management on working capital, cash flow forecasting, visibility. Most recently, Silicon Valley Bank, First Republic also created much more attention from senior management on where is our cash. Also, the fact that we can't repatriate all our cash is an important aspect of senior management to look into liquidity, cash forecasting, and the like.
Yeah, no, great points across the board. I think on both sides, it's definitely in alignment with a lot of what we're seeing in general. There were a lot of companies that post-pandemic maybe didn't even measure cash flow accuracy, like you said, Duncan, because they had plenty of cash. They said, hey, the forecast is off by 25%. It doesn't necessarily matter. This is just a reporting exercise for us. We have to produce this once a month, right? But as you got into the pandemic and things got really lumpy from a receivables standpoint, from a lot of other factors and things like that, a lot more questions were coming in from the C-suite, from the top level around where's the cash, what's causing the variability, what's causing the disruptions. So caused companies, I think, in a lot of senses to focus more on accuracy, focus more on the durations in which they were forecasting. And then also think about areas outside Treasury. We saw, I think during that time, really tight relationships start to be formed with like the AR departments and AP departments to really have conversations with people and understand, hey, why is DSO up 7 days in the last 3 weeks? And, what payers are we tying this to? What are we doing about it? And things like that, right? And that's kind of persisted going forward, and it's driven a lot of the sophistication and the process improvements that organizations are really looking for in their forecast from what we've seen. So it's been kind of an interesting transformation to watch over the last few years. But and then Gerard, I know you've been living this. You guys recently went through a transformation project where you completely revamped your cash forecasting process. So very interested to hear about maybe some of the primary challenges you were looking to solve, and were they purely kind of operational improvements to the forecast, improvements to to accuracy and things like that? Or were you kind of thinking, going forward a little bit about some of these, macroeconomic type events, rising borrowing costs and things like that as you put in place your expanded forecast process?
The short answer is it's a bit of both. We, like Duncan said, we didn't have much of a forecasting process within Unilever. It was manual for some countries. It was not existent for other countries for cash pools. The countries, entities that paid most attention were those that got penalized for being overdrawn on the bank accounts overnight. So there wasn't a clear structured process within Unilever, fragmented, manual. Back in 2019, we decided to look at this. It was the time, interest rates were still pretty low, but we foresaw interest rates rising in the years thereafter, which turned out to be the case. And there were also more products in the market that could help cash forecasting, short-term, longer-term. Next to all the other innovations in the area, machine learning, AI, and the likes. So we did a small project we chose a vendor. I mean, we did the usual RFP. We ended up with TIS, Castforce, Cas Optics, still using the old name, sorry for that. Yeah, so the decision was made to do a bit more around cash forecasting. Initially only for the shorter term, but later on we depending on the data quality, we also looked at the data and the forecast longer out. So yeah, to answer your question, it was both operational challenges, interest rates that were rising, but also the fact that yeah, better systems, better technology, better ways of integrating were possible. And I think with selecting TIS, we also made a strategic decision to go ahead for a smaller fintech rather than a big SAP. We're an SAP firm on the business side. So it was also a strategic choice that we made at the time, that we wanted to be flexible, wanted to integrate quickly, and wanted to own our own tool, our own system, which obviously we got some queries back from enterprise architecture, our IT of the department. Why not SAP? But yeah, the business case was clearly in favor of TIS, Cas Optics. And the aspect there is as well that we own the tool rather than having it in SAP, where the larger IT community within Unilever owns it. We are much more flexible right now. We had some discussions about vendor risk at the time, but yeah, I mean, already at the time, a few banks, including Citi, were supporting the company. That's why we installed and implemented Cas Optics. Relatively easy, a couple of months before we could install it. Yeah, I think overall we pretty happy with the solution so far.
Yeah, that's great to hear. Yeah, maybe digging a little bit deeper into one of these points. One of the big prerequisites that corporates have to sort of address before they can get to the level of granularity that they want around their forecast and be able to create a forecast as frequently as they really would like to is the data. That tends to be the biggest roadblock for a lot of organizations. It's consistently coming up in survey results as the biggest impediment to increasing the frequency of forecasting, getting to the level of granularity and analysis that you want to, right? So different strategies for how to go about this, but Unilever put in place a data lake essentially before the forecasting process, the forecasting transformation project really took off here. And that data lake really feeds all the forecast source data to the forecasting tools. So I want to see if maybe you could talk a little bit about that approach, what really drove that level of thinking, and maybe some of the sort of lessons learned, the benefits, the risks, the issues you've seen come up with that approach over time as you've incorporated that into your forecasting process.
Yeah, indeed, we use the data lake, the data repository that we have in place. To be completely frank and transparent, we already had a data lake. People probably know, but we are a global company, 190 countries. Luckily, we only have 4 SAP instances in the globe, and that helps. But all the data, or most of the data that we have in the SAP ECCs, are moved on a daily basis into a data lake repository for different kind of things, not only for financial reporting, also supply chain, etc. It's for analytics, insights, etc. So the decision when we went for Cas Optics quite quickly was made to interface with the data lake rather than with the different ECCs, because it's one interface versus 4, and which made it much easier, much quicker in terms of implementation, much easier to install it and quicker to use. So the data lake clearly has benefits. What we a bit underestimated, but that has not much to do with the data lake, has more to do with the underlying data quality, is that we underestimated to look at that before we pull the data into Cas Optics. With hindsight, and I'm not sure we touched on lessons learned, but with hindsight, we should have looked at the underlying data first before we went full steam ahead and started importing the data into Cas Optics. So definitely from an integration perspective, having a data repository is a good thing. I think it requires vision on data if you want to implement a data repository, a data lake. I mean, we use it for this purpose, but we use it for many other purposes as well. So it's a great thing to have, but it requires a strategy, a vision on data within the company.
Yeah. And John, if I can add to that as well, I mean, the infrastructure is so important to actually deliver on some of the outcomes that our clients are looking for. And it's interesting, Gerard, data lake, he had 4 instances of SAP, Gerard, right? I mean, many of our clients have multiple instances and different versions of different platforms, and not just single provider either. It could be across SAP, Oracle, Microsoft, other. So there's really two schools of thought out there as how to go about resolving that. And one is obviously in the approach that Unilever took, where they look for the TIS overlay and the data lake to actually consolidate the information into one place in the cloud, I guess, Gerard. But others are trying to consolidate ERP instances, which is another way of going about it, and that's where really the debate is right now across many organizations as to which path to take. There's never one right answer, and it really depends on the organization, how they go about doing things, what skills they have, how many instances they've got, their path to upgrade, these other things that are going on, and other impacts as well. But they're the two schools of thought, John, and so just wanted to offer that, Gerard, because it's not just one answer. There are multiple answers to this.
Yeah, no, makes a lot of sense. Yeah, and I think most of the listeners are probably familiar with Unilever, but big global complex company, lots of different consumer brands rolling up under that name, right? You guys are operating in a lot of emerging markets, and I think you highlighted some of the systems complexity in terms of having that data housed in multiple different instances of SAP, and I'm assuming probably other systems as well as sources for that forecast data. So it's good that you guys had the foresight to think about that, getting all that data together and how that was going to really be a driver, a facilitator of the improvements in your forecasting process. But the pitfall you ran into is a common one as well. It seems like no organization really knows how clean their data is until they really get into it and really start trying to use it for analytics purposes and things like that. So.
And the other piece, John, to it is that many corporate clients obviously are growing, right? The growth is obviously important, and many grow through inorganic activity. So they're inheriting multiple technologies almost by default on a regular basis, and that's where it can become quite cumbersome and expensive depending on the strategy you adopt. So it's we often get asked at Citibank within our client advisory group, how do I future-proof my future technology stack? And that's a difficult question to answer, but it is flexibility. It often goes back to flexibility and the nimbleness in the technology stack to absorb and acquire new technologies. And that's an important aspect to consider. And I'm not sure that was part of the consideration at Unilever, but it's certainly the considerations for many of the clients we're engaging with. And how do you quickly reestablish your cash position? How do you quickly reestablish your future cash exposure, your future cash positions across a myriad of technologies that can be extraordinarily expensive to consolidate and can take time to consolidate post-acquisition?
Yeah. Maybe one other thing to add to this is a bit underestimated on our side as well, because of the setup at Unilever. As Treasury, we were a sort of silo within the organization, just like P2P and order to cash. You mentioned, John, that working together has increased over the years. That is certainly the case, and that's what we see happening right now as well. So implementing a tool like this definitely helped us in getting the processes better on that side. But when we started, we were not clear on the drivers of the cash. And what we found out over time is that selling ice creams in Turkey creates way different collections than selling home care in the US or in the rest of Europe. So we got to know this when we started using the data, or started looking at the data and starting digging into the details. Getting to know the sources of your cash or your payments was another great thing to find out over.
That makes sense. Yeah. The maybe move into the next discussion point here. Duncan, we've gotten here a bit from Gerard about what the challenges were for Unilever in their forecasting process, what the objectives were, what they were looking to really achieve. Citibank, obviously major global bank, right? You guys get the benefit of talking to a lot of different clients, a lot of different sizes, a lot of different industries on a day-over-day basis. Are there any kind of themes that you see consistently come across in terms of what organizations are looking to solve for in cash forecasting today? Where are they coming from? Where are they trying to get to in their processes? Is there anything kind of like underlying story that you see emerge universally across your client base?
Yeah, I mean, look, for that, I mean, I think the point maybe is that it doesn't start with the decision, let's get better at our forecasting. It actually starts, the conversation starts in a different place. So it's It's more about how can I get better insight over my financial performance and my financial position? How can I allow management to take action to improve the company finances? How can I plan for capital expenditures and a procurement or an acquisition? How can I track the receivables and the payables across my organization? How can I scenario plan for the next black swan event that comes about? How can I actually understand what impacts that's going to have across my organization? And how do I test my liquidity access plan to ensure I've got sufficient funds to ride through the next disruption, so that it doesn't negatively impact or inadvertently impact the company, so to mitigate that. So they're the type of questions that clients are asking themselves, and often when they're thought through on a whiteboard, it comes back to, I need to have better visibility over my cash. I need to have better visibility over my future cash position. I need to understand the working capital dynamics. I need to understand my supply chain dynamics. I need to understand the credit risk going across my business model. And that then goes back into what Garrett's talking about. Well, now I need to better understand my data, right? So it comes back to a data strategy story, right? So it starts with what do I need to better understand to make more informed decisions, and then that drives through, well, better visibility and better forecasting and better understanding across my supply chain, and that then drives into a conversation about data again. But that's certainly the pattern that we're seeing, and some of the just offer maybe as well as that to go alongside that. We mentioned ERP systems a couple of times, and as maybe some of the audience that are joining us today who know me from Citibank, we offer a diagnostic, Citi Treasury diagnostics, to actually understand the performance of client treasury, and we measure it in a couple of ways. Whether it's the policies or the procedures across various attributes of treasury, be it risk management, subsidiary funding, policies, technologies, but we look at it in a few different ways. And what we're seeing is a much greater focus now by clients on automation as opposed to deploying new processes. Is actually the focus is much more on automating the right processes to drive efficiencies and effectiveness through the operation, and forecasting is absolutely part and parcel of that. So we're seeing when we look at the pure benchmark, the treasury diagnostic across the more typical legacy, if you like, measures around in-house banking, liquidity structures, use of shared service centers, that's all improving over the last 2 or 3 years, 4 years by about 5-6% when we do an index across 400 or 500 clients over the last 4 or 5 years. But when we look at the digitalization index, where clients are focusing on better automation, better connectivity across their infrastructure, better levels of straight-through processing, that's improving by about 20% over the last 3 or 4 years on an index basis. So there's definitely a focus now, for the reasons I've outlined. Looking for those better understanding across an organization to be able to survive the next disruption event, to really look at the automation of processes and the better utilization of data.
Yeah, from that standpoint, I guess the company's looking to drive a pretty deep level of analytics and planning functionality through their forecasting tool. If you look at some of the survey results that are out there and things like that, it seems like you're still seeing kind of consistently around that 30-40% of organizations still using Excel to do their cash forecasting. Is that kind of what you're seeing with clients, you think, or is it?
I would say more. It's an interesting one. We were looking at this a month or so back, and when we look at we've got 1,200 participants now in this study. I'm not sure where that's coming from, but anyway, we've got 1,200 participants in this study, and when we look at that, there's about 70% of them actually are using SAP. It's clearly the leading ERP provider across all the clients that participated in this study with Citi. But at the same time, 80%, 80, are still using Excel.
Wow.
to support their forecasting process. So clearly something is wrong, right? If 70% are using ERP systems as sophisticated as SAP, yet 80% are still using Excel to provide their forecasting or support their forecasting process in some manner, then there's a disconnect. There's something wrong with that picture, and I think where perhaps some of the innovations that we're seeing, some of the fintech companies around the globe to support clients better understanding of forecasting across their technology stacks, which are fragmented and broken. I think that's where the challenges really reside.
Yeah,
but to that, sorry, John, but to that, Duncan, what we found out when we looked at the data and rolled out cash optics, it really takes a project to do that. It takes people, extra resources, because you can't do it as part of your day-to-day job. So you really need to plan a project to replace your Excel with whatever system, be it SAP or something else. You can't do this just by looking at your Excel data. You really need to spend time and people towards it. Otherwise, it's not going to work out.
Yeah, that 80% stat would be an interesting one to dig into for sure. I mean, that's a huge number of organizations still using Excel for forecasting. But I mean, we see that too. A lot of people looking to progress their forecast process use their current forecast tool as just one piece of the puzzle to pull in some portion of the forecast data. But then they're taking that out and they're putting it in Excel and combining it with other sources to ultimately build this forecast. This is what's taking all the time. This is what limits them from being able to only forecast once a week or even once a month, and not really be able to use that forecast to really manage cash and liquidity. So, but even so, that's an enormous number, 80%.
It is, and what's interesting as well, just to move it along, is we spoke about accuracy and forecast accuracy a moment ago, and what can often be a conversation with clients that we engage in, is to find out, are they measuring forecast accuracy? And often our clients are measuring forecast accuracy, and then when the next question is, well, what is your accuracy? And they don't know, or how far out are you at that level of accuracy? And again, they don't know, because most of the accuracy measures that are offered to us is for tomorrow. Like I know what my position is tomorrow from my spreadsheets, or the next day. But as Gerard will appreciate, to make informed decisions about investments or funding at longer tenor, of course, you need to know your accuracy much further out to perhaps as far as the payment terms go in your payables and receivables, which is 12, 13 weeks. So to measure accuracy at that tenor, to start enjoying some of the greater yields that are now available, or indeed to avoid some of the interest expense, you need to move to something a little bit more systematic to really understand and measure the accuracy, and measure the accuracy over time. Because if you look at just tomorrow, well, if it's not 90 something % accurate tomorrow, it'll be a lot less than that when you look 14 weeks out. So you have to measure that and understand from how far out can you start making real decisions. Because of course, and I'll say it again, John, it's not about forecasting, it's about enabling the next action. It's enabling the decision, be it investment or funding or hedging decision. That's why you're forecasting. You're not forecasting just to have a nice picture of what your future cash exposure is. You're doing that for a reason. And certainly Gerard can certainly speak to some of those reasons at Unilever.
No, I think you're spot on, Duncan. In the past, before we did this project, we were happy that we ended positive on the bank account the next day. If needed, we funded ourselves with via commercial paper, and we rated so we could easily enter into the CP market. Right now, we use the data to invest 3 weeks, 6 weeks, 2 months out, depending on the data that we see coming back in. Whether it goes for investments or borrowings, it depends on the country, the entity, or whether we do or swapping out the cash that we have. We're much better able to make informed investment or borrowing decisions. So it's really paying off. It changed the ways of working considerably on our side.
Yeah, and I mean, you guys hit the nail on the head. The whole purpose of forecasting is to ultimately have a forecast that makes you a more informed cash manager and makes those decisions better, right? So that's the whole point of it, not to create a report overall. But maybe moving here to the next topic. Gerard, we talked a little bit about the data lake, which is one technology I think a lot of the listeners are probably really interested in. But you guys actually incorporated another one into your cash forecasting process as well, which were real-time balance APIs. There's a lot of buzz about this in the market, a lot of interest in real-time balance APIs, real-time cash management strategies, to the theme that we just discussed, right, about being better cash managers, being more proactive cash managers. So I was hoping maybe you could take a few minutes here and just sort of, maybe talk through your experience with real-time balance APIs, and maybe what were some of the use cases you guys were ultimately seeking out as you implemented those technologies.
Yeah, no, APIs is I mean, it's definitely a new kid on the block. It's a different way of connecting to your banks or to whatever party. It's becoming more mainstream in the financial world. It's been out there already for longer in other parts of the business. We first looked at this with another bank. The data that we got in via the API connectivity ended up in Excel, which was a real quick thing to test, and we were really curious on how that worked. But it was relatively straightforward, and it gave great insights already. But it ended up in Excel, so it's nice. And again, it's Excel, so part of the 80%, I guess. Yeah, when we started looking at cash flows and implementation, we thought that for the shorter term cash forecasting that we do, it will be good to base ourselves on the latest balances that we have on the bank. So payments being executed, latest collections on the account. So we worked together with TIS Cash Force to set up a connection with 5 of our main cash management banks, where we have around 50% of our bank accounts, and they cover around 70% of the volume globally. So TIS Cash Force implemented the connection with the banks. Each bank required a different discussion, different formats, different certificates, different kind of security. So it wasn't so straightforward to implement connectivity with each of the banks. So it took longer than we'd hoped and expected, but it's working now. So it's great. We one push on the button and we see the latest balances on the accounts in the cash pool or whatever, and it helps us determining the latest balances that we can use to invest overnight if we want to, or to borrow overnight if we need to, or to transfer from one cash pool to another cash pool if required. Was next to trying out new ways of connectivity, API in this case. Newer technology. It also really helps us doing short-term cash forecasting, cash management actually.
Yeah, that's obviously the biggest use case it seems like most organizations are looking for with real-time balance APIs is they plan to actually manage, reposition cash intraday, manage cash intraday, and ultimately make a cash management decision. So, but to do so, obviously you need tie-ins to other programs as well, like programs that allow you to maximize yields or take advantage of maybe trade finance programs, supply chain finance programs, and things like that. So Duncan, maybe you could talk a little bit about the tie-in, between some of your customers. Obviously Citi has a, real-time balance API like Gerard mentioned here. Your customers using those real-time balance APIs to really position cash intraday. How are they then making cash management decisions real time that are really benefiting their businesses?
Yeah, look, if I may just maybe step back to pick up on a couple of things that before I get into that, John, but just a couple of things that Garrett picked up. I suppose the way we look at real time in Citibank really is across a number of dimensions, and it's, Garrett's talking there about the really real time information to enable intraday cash management, which, we did a snap survey just a couple of weeks ago with about 50 clients, and just under 80% of them, so 4 and 5 out of 5, wanted real-time information, mostly via API, to support that cash management process that Garrett's talking about. But for a long time, and indeed it continues, companies with, e-commerce and B2C business models utilizing material volumes of instant payments, right, is where a lot of the conversation kicked off. And this is now emerging, this need for real-time liquidity management to support those real-time payments, especially as the instant payment technologies are moving into 24/7 across banking providers. But it is true, across all industries, all business models, companies now, they're starting to work towards real-time treasury and real-time liquidity management, as Garrett's talking about. But it's really those 3 layers is the point I'm trying to make. There's the real-time settlement, which is about the instant payments and supporting e-commerce, supporting B2C. And then there's the real-time information that I think Garrett is utilizing for cash management at Unilever. Then it's moving towards the next level, which is the real-time liquidity. And indeed, it's not 4 and 5 looking for real-time liquidity yet. It's less than that, but it's greater than 60%, right, who are looking for real-time liquidity. And companies are challenged, right? Because many companies, when we talk about the data fracture and the data challenge and the technologies that many of our corporate clients have through acquisition that are not necessarily connected, when you start loading API transmission on top of that and start trying to accelerate the decision making based on real-time information, it becomes extraordinarily difficult for many clients to actually go about doing that, even if the banks provide an API in a standard way, which we don't, because we've got different standards. The standardization is loose, as we all know. That's a work in progress across the banking community. But even if that was there, I think the ability to consume real-time information, and again, what's the point? To make decisions based on having real-time information, to be able to make those decisions in real time is not quite there yet in many corporate infrastructures. So I think there's challenges to unlock and unpick. And look, we're working, to your first question, we are of course working at Citi to support much of those real-time aspirations for our clients. So real-time multi-banking APIs, as you spoke about a minute ago, bringing that together, real-time cash position on a multi-bank basis, real-time cash concentration on a multi-bank basis is another piece that we're looking at. Real-time funding to turn the sweeping into more frequent and timely to support on-time information, if you like, or on-time funding, as some of us are now calling it, as opposed to real-time, it's on-time. And then, of course, the 7-day sweep piece they're working at Citi as well, to move into the 7-day operating model to support clients on banking holidays and indeed through weekends. So it's a when we talk about real time, it's a large topic, and many of the pieces we talk about, we try and move away from talking about an API, because of course an API is just a transmission protocol, right? It's what's the point, what's the purpose, what's the objective, what's the outcome that our clients are trying to achieve, and real time may or may not be the answer, right? It may just be that they need a more frequent feed of information to support a decision at a point in time, to support a cash management process. It may not need to be a continuous update of real-time information, because quite frankly, a human being can't make a decision in real time. So the extension of this, of course, is automation in its fullest sense. So for me, real-time information, the natural extension to that is a real-time liquidity and a real-time treasury, making decisions. And of course, to do that, that's the next level of discussion. Maybe we touch into the next level. But I think the real-time piece is a building block to getting to that real-time decision making, which of course a human being can't do.
Yeah, no, I think it's definitely important what you said, to keep the actual use case, like how does this actually make my business better, firmly in focus. So, which was actually one of the nice parts I think about going down this path with Gerard and Unilever with TIS, is just, we had a use case behind it. We had a corporate that could really explain how this would make their business better. And we got to go down that path of helping them explore that use case, which is definitely one of the benefits. But Gerard, you did a great job, I think, highlighting the complexities, that come with APIs these days. Duncan, you mentioned historical, protocols for pulling information. We're just exchanging files through a secure protocol. APIs are a development project, right? It's different APIs for every bank. In your case, 5 banks, 5 APIs, different capabilities of those APIs, even whether it's just balances or balances and transactions, whether they're webhooks, whether they're just REST APIs that go and retrieve an MT942. It's all over the place. This is kind of what the market's dealing with these days in terms of the lack of standardization around APIs. But another thing that definitely seems like is going well on this topic is that the corporates are pushing it. They're pushing the banks to provide these APIs. They're pushing the fintechs to help them pursue the use cases around it. So hopefully we start to see this, these technologies start to deliver real value to the Treasury community, over the course of the next year or so. Maybe switching to another topic here. Another tie-in I think that's becoming sort of a heavy component of cash forecasting is this, the topic of working capital. Looks like, whether they're maximizing their overall liquidity standpoint. Also a big component of the variance analysis as well, if you're looking for reasons why cash are not quite what they should be in the last week or last month, looking at working capital capital metrics like DSO to increase the lines, right? So Treasury is definitely tying these activities a lot more closely together, forecasting and working capital management. And it's actually a big way that Treasury is able to drive a lot of strategic value in a lot of organizations by being a business partner beyond Treasury to help the business optimize working capital. So from that standpoint, Gerard, maybe you could talk through, what's Unilever's strategy around working capital management? What are you guys doing, today around this topic? What sorts of reports are you generating or metrics are you evaluating as part of your overall working capital management process?
Yeah, it's an interesting one. I think most of the working capital components, AR, AP, inventory, is managed by the business. Obviously, we get to know if things go wrong working capital wise, if the business wants another working capital loan needs to be funded or so. I think where we come into play as Treasury is when it comes to discussions with banks about supplier financing programs, solutions on the inventory side or on the receivable side, with potentially factoring or otherwise. Within Treasury, at least within Unilever, we're sort of facilitator between whatever procurement, finance, or whatever type of the business is responsible for the working capital component with the banks, rather than we play an active role. Of course, managing your cash on a day-to-day basis is part of your working capital management. Other than that, we're not so much involved in the day-to-day operations on that side. So it's the business group, the business unit that manages its working capital. When it comes to negative working capital in certain countries and building up cash, we're involved in potentially moving the cash out or whatever. Other than that, we're not so much involved. Maybe to add is that we have what we call cash committee, which meets on a regular basis. Treasury is part of the discussion, and depending on the needs, we do some actions to make up working capital by some fast cash actions or delaying payables a bit. And maybe I should not mention this, but it sometimes happens. So I think Treasury's involvement on our end is more facilitating than actually actioning.
That makes sense. Are you guys delivering the insights to the businesses around like the working capital metrics, or is it mainly even the analytics piece of it's probably driven more locally from the business unit?
It's driven locally, yeah. One of the things we want to do, which we haven't done yet, is use cash optics to give the business a bit more insights. We are at the moment installing the working capital functionality. We have not done so yet. So when that is fully in place and when we have a clear view on how the functionality works, we could have another type of discussion with the business based on that data. So again, it's coming back to insights and data and visibility.
Yeah, no, it makes sense. I mean, yeah, it definitely seems like you guys are in a strong position where you have the data compiled in that data lake. You're able to drive probably, working capital metrics, working capital sort of KPIs and things like that universally with consistent methodologies and things like that. So yeah, it'd be interesting to see what you guys do on that front on a go forward basis.
But just to add to that for Garrett, just for the listeners today, I mean, I suppose the uber point here is the underlying data sets, the payables, receivables, invoices, payment terms, and whatnot. That underlying data set supports not just better forecasting, but also enables insights into the cash conversion cycle. So you can start the same, I suppose the same effort gives you a double return. It gives you the return not only on the forecast, but also an adjusted forecast based on historic payer behavior. So you can start understanding where your payers are paying on time or not, to Garrett's point. You might be paying a bit late, but in the same way on the receivable side, you may be receiving a bit later than you were expecting. And that might be trending, there might be structure there. So if there's structure there, then you can start adjusting your forecast to be more accurate based on that historic payer behavior. And we hear a lot of talk about AI, and for me, AI in this field is actually more about machine learning and pattern recognition in historic data to be able to adjust and better inform a future or predictive measure of your currency exposure. So that's what AI means to me in this world, by the way. But it's much more about, I suppose, understanding the structures that are flowing through the data when you have it consolidated and pulled together. And also, I suppose, the other byproduct of this, of course, is the understanding of the cash conversion cycle. So the basic metrics of DSO, DPO, etc., but also the late payers and all of the rest of it that feeds into your overall cash conversion cycle metrics.
There's definitely a lot of opportunity there. It seems like, if you're already pulling in that data to drive your cash projections on a day-over-day basis, your receivables and payables data, driving an extra level of analytics around that to just understand DSO trends within your business lines. And if there's something kind of inefficient going on from that perspective that's impacting cash flow is a nice, kind of second level analysis you can do there. Or even more, basically, we see a lot of companies will just look, they'll have the fragmented data like we talked about before, siloed by ERP system or region, whatever it might be. And then if they're able to kind of combine that all into one data source, they can suddenly see, hey, we have different payment terms for the same vendor in multiple different business lines. Let's bring those together, and ultimately they're able to, just improve working capital through better analytics from that front. So yeah, definitely a big area where Treasury can kind of drive value within organizations today, in addition to just cash flow forecasting. So I know we're kind of coming up, close to the end of our session here, and I definitely want to leave some time for Q&A. So maybe I'll just, end on one point here that I know will probably be important to the listeners is, in terms of how does Treasury measure the ROI of implementing a forecasting solution? In your opinions, maybe, both of you guys can take a stab at this one, because it seems to be kind of all over the place. A lot of people do it by accuracy. We're within the 30% accuracy today. We want to get within a 15% accuracy or whatever it might be, but there's a lot of different ways you could think about it. So Duncan, maybe I'll go to you for first words on this one.
Okay. I suppose for me, if I was to, not that I would ever purchase a forecasting system, but if I was to, I suppose I'd be more, and what I'm hearing from clients, in fairness, is that I'm less concerned about the forecasting metrics themselves. I'm more concerned about the financial outcomes on the back of having better forecasting. So the ROI really needs to be a measurement of financial improvement, financial performance improvement for the organization. Yes, based on perhaps more accurate forecasting. It's what you do with the forecast. And I've said that a couple of times in a few different ways, and I hope it's coming across for everyone. It's the next action that's important. So in the same way, in the same vein, for the return on investment, it has to be, well, is the next action more effective, as in you get better returns or reduce costs? Or is it more efficient? And by efficient, I mean by that is, what does it take to get to the point of Gerard making a decision? How long does that take, and how many people's hands and minds does it go through before the information is in front of Gerard's screen to be able to make that decision? So that's about operational efficiency. So it'd be like there's 2 or 3 buckets of ROI, the way I think about it and the way I explain it to many of our clients at Citi. There's the financial outcomes. There's which is what I've spoken about, so the returns, etc. There's the operational efficiency. So that can be, the headcount reduction, the reduction in manual processes, the saving in reducing the use of Excel. Maybe there's a rationalization of a couple of systems, so the cost of ownership goes down. So all of those things feed into it. And then the third dimension to this is actually the simplicity of the onboarding itself. So if you've got an extraordinarily good system, but it takes 2 years to deploy and 300 people, that's a problem. So it has to be easy. It has to be simple to deploy. It can't be disruptive. It can't divert the attention of already overstretched Treasury resource to mobilize a large program work effort, as I'm sure Gerard will touch on, right? It needs to be as simple and as efficient as possible to bring it about to actually onboard. So it's those three things. It's the better financial outcomes, 1, 2, the operational efficiencies that it drives out, and then thirdly, but importantly, how easy it is to make happen, to actually bring about.
Not sure what I can add to this.
You said it all.
True.
Okay.
Yeah, he said it all, Duncan. Yeah. We're one of his clients, so I think he told us as well where to look.
Yeah, that financial outcomes.
I won't admit to writing the business case for Gerard, so I won't admit to that.
Yeah, but all was there. All of this was there, to be honest.
You're even starting to see things bubble up to the executive level, where executive compensation is tied in some cases for a lot of Fortune 200 companies to free cash flow versus like historical P&L measures like revenue growth and profitability and things like that too. So you can definitely see the rising emphasis on cash flow within organizations, and the fact that people want to measure it and really you get real benefits out of improvements in their cash flow forecasting and working capital optimization programs. So yeah, I think that's a great one to highlight there. All right, we went a bit longer than we expected here, but I think we do have still 5 minutes left to address any questions that might have come in from the audience during the course of the session. So Jen, maybe I'll bring you back out here, and and maybe if there's a handful of questions here that we could address for the last 5 minutes, we're happy to do so.
What's the time period over which you forecast cash? Is it short term, 13 weeks, or do you forecast out a full 52 weeks? Also, a follow-up: what is your threshold for measuring accuracy?
It's one that we get a lot. We started with a really short term forecast, up to 1 week, 2 weeks in the beginning of the project, but quite quickly we could extend the horizon to 13 weeks, and that's what we're doing at the moment. So let's say quarter out. So we look at 13 weeks in our investments, in our borrowings, in our cash management, liquidity swaps. Maybe we could do this longer out at some point, but no clear plans as of now.
Going beyond payment terms requires slightly different methodologies to be adopted. And just, I won't say much more than that now, but just, I suppose the type of methodology typically adopted is a direct methodology where it's based on payables and receivables. When you go out to 52 weeks, you're talking really about, organizational planning and business planning, which is a different type of indirect forecasting methodology that needs to be adopted to convert those longer term plans into cash flows through the year to achieve that outcome. So it's just a different methodology. And I'll stop there because I'm conscious of time, but just to be, for those folks that asked that question, to be aware of that.
Sure thing. Thanks so much, Duncan. All right, Catherine just had a question that came in. What suggestions do you have for the 80% of clients who still use Excel to improve their cash forecast process?
Come off Excel.
Okay, great one. Niraj asked, what specific insights do Treasury managers typically seek from forecasting tools to improve their forecasting?
I think that kind of insight information is what a Treasury management wants to understand in order to determine his forecasting and his forecasting horizon.
And accuracy, Garrett. So the other measure is what typically folks can't do on Excel. And I was a bit short on that previous question, but I'm happy to take a longer time offline if that person wants to make contact. But the point is measuring accuracy and measuring accuracy over time identifies where the inaccuracies are coming from to mobilize projects to fix that. Okay, so you have to you can't fix something if you don't measure it. So you have to measure to manage. Remember all that kind of good stuff? So you have to measure the accuracy to be able to identify where to fix the issue. And that comes from.
Yeah. I'd agree with that too. I think it starts with really granular data inputs and then a really good variance analysis that's automated so that you can really dig into the reason for that variance. And we could go on and on about this topic probably for a whole coffee talk session, but if you were to take, say, your cash receipts driven by your accounts receivable, for instance, if that was off in a given week, there's a lot of reasons why it could be. It could be that maybe you forecasted incorrectly, used an improper logic or methodology to be able to project out cash from those AR receipts. But it could also be that maybe revenue was off, in terms of what was the underlying assumption there for your revenue projection. Or it could be that maybe your DSO went up and what you're using to, your baseline assumption for what DSO would be, that ultimately, would convert that into cash was off. And that could be because of some sort of inefficiency within the business or something correctable. So it's almost like you have to get to that point where you determine, is it forecast error or is it business performance? And then from there, you have to sort of even broaden it out a little bit more to be able to determine how to make that forecast more accurate. But yeah, you'll be able to get there. You'll be able to chase down those trails, have granular data inputs one way or the other, which is nice. So.
All right, thanks so much. I will turn this back to you, John, because I know we're up against time. We did have a bunch of questions that didn't get answered. We'll reach out to you individually, and thank you so much for putting them in the Q&A box. So John, back to you.
All right, sounds good. Thanks, Jen. Yeah, thanks everybody for those questions, and apologies that we ran a little bit late here today. As we wrap up here, Gerard, Duncan, just have to thank you again for joining today's Coffee Talk session. I know I really enjoyed the conversation here today. We got to hit on a lot of really interesting points, so appreciate you guys joining this session.